Welcome back to our weekly personal finance recap, where we break down the major money news from around the world and how it might affect your wallet. This week, Sept 1-7, 2025, brought a whirlwind of economic developments, from surprising job numbers in the United States to evolving interest rate policies in the UK and Australia, inflation milestones in India and Europe, and the ongoing financial squeeze in Nigeria. We'll dive into why Wall Street got the post-summer jitters, how British house prices hit a record high, yes, again, what's brewing with inflation from Delhi to Frankfurt, and more. Don't worry, we'll keep it analytical and sprinkle in a bit of humor, because even in finance, we all could use a laugh. Let's jump in. United States. Labor Day whiplash on Wall Street. United States. The New York Stock Exchange on Wall Street. U.S. markets reopened after Labor Day to a surge in volatility and rising bond yields. The week kicked off with U.S. markets waking up from their Labor Day slumber in a rather grumpy mood. Historically, September has a reputation as Wall Street's worst month, and 2025 is so far living up to that fame. When trading resumed on Tuesday, simmering anxieties boiled over. Investors were immediately confronted with a cocktail of concerns ranging from Federal Reserve independence to fresh doubts about the legality of tariffs on Chinese goods. It was as if the market collectively had a post-vacation hangover. Stocks stumbled, the S&P 500 fell about 0.7% that day, and the famed volatility index, VIX, spiked to its highest level in a month. Welcome to September, folks, where Wall Street's idea of easing in gently is apparently a 0.7% drop before your second cup of coffee. Why the sudden turbulence? One big factor was politics colliding with central banking. Over the holiday weekend, news surfaced that a U.S. appeals court ruled many of the White House's tariffs were illegal, throwing a wrench into trade policy. This reignited trade war fears and triggered a risk-off rush. Think investors sprinting away from stocks like they just saw a bear market in the woods. At the same time, an open tussle was brewing between President Donald Trump and Fed Chair Jerome Powell. Trump, never one for subtlety, had been publicly pressuring the Fed to cut rates yesterday, even moving to oust a Fed governor and install a more pliant voice. Raters worried that political meddling could erode the Fed's independence and rattle the normally steady U.S. Treasury market. In other words, it's not great for investor confidence when the central bank might need to start each meeting with, as I was saying before I was so rudely interrupted. All this drama sent bond yields surging. The benchmark 10-year Treasury yield jumped to about 4.27%, while the 30-year yield hit its highest since mid-July. Remember, when bond prices fall, their yields rise, and rising yields can be a wet blanket for stocks. Why risk stocks when safe bonds pay over 4%? In fact, analysts point to approximately 4.5% on the 10-year as a level where stocks really start feeling the competition from bonds. The immediate fallout? Higher yields lifted the US dollar, good for your overseas vacation budget, tough on US exporters, and put more upward pressure on mortgage rates and other loans. Indeed, average 30-year mortgage rates hovered near multi-decade highs, north of 7% for many lenders, meaning prospective homebuyers got absolutely no Labor Day discount. If you're house hunting, you've probably developed a nervous twitch watching those rates rise. It's the opposite of retail therapy. Speaking of homes and loans, American consumers are facing a mixed bag. On one hand, those with high-yield savings accounts are quietly pleased. Savings rates have remained juicy, often in the 4 to 5% range. In fact, high-yield savings and CDs are a rare silver lining, finally rewarding savers after years in the low-rate desert. But on the flip side, borrowing costs for everything from cars to credit cards are biting. Many credit card APRs have breached 20%, and average 30-year fixed mortgage rates, as mentioned, are at levels not seen since your grandpa's day, assuming grandpa was house shopping around 2000. The result? Refinance activity has slowed to a crawl, and buyers are getting creative. Cue the return of 2-1 buydown offers and seller-paid points in hot markets. It's a tough environment if you need a loan, but at least your emergency fund is finally earning something. One could say the Fed achieved the impossible, making savings cool again. Now, the biggest US news item: jobs, 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 or the lack thereof. On Friday, the Labor Department's August employment report dropped, and it was a doozy. The US economy added just 22,000 jobs in August, a dramatic downshift from earlier in the summer. To put that in perspective, that's basically a rounding error in a workforce of over 160 million. The unemployment rate also ticked up to 4.3%, nearly a 4-year high. In plain English, the red-hot labor market we've seen over the past 2 years is cooling off fast. Stall speed is how some economists described it. The labor market plane isn't crashing, but it's uncomfortably close to losing altitude. For the Fed, which has been on an interest rate hiking spree since 2022 and only recently paused, this jobs report was like a giant neon sign flashing, time to cut rates. Fed officials have been desperately trying to slow the economy to tame inflation, and it looks like they, and perhaps Trump's trade policies, finally tapped the brakes hard enough. Indeed, the weak jobs growth sealed the case for a Federal Reserve interest rate cut later this month, according to Reuters. Markets are now betting that at the upcoming September 16 to 17 FOMC meeting, Jerome Powell and team will cut the Fed funds rate by 0.25%, the first rate reduction in over a year. Just a month ago, that was only a maybe. By this week, futures showed an 80% plus probability of a cut. What a difference a few lousy jobs reports make. How are regular people feeling about all this? Consumer confidence in August dipped slightly but held relatively steady. The Conference Board Index came in around 97, 1985 equals 100, a modest decline that basically says consumers are wary but not freaking out. However, the University of Michigan's sentiment survey told a more sour story, dropping about 6%, perhaps reflecting those rising gas prices and non-stop recession chatter. Yes, gas prices. Although oil prices have seesawed, at the pump Americans saw a late summer uptick. National average gasoline rose back toward $4 per gallon in many states, partly thanks to OPEC Plus cuts earlier and summer driving demand. By week's end, OPEC Plus actually agreed to boost oil output from October to reclaim market share, which could ease oil prices going forward, but any relief will take time to trickle to gas stations. Higher gas and grocery bills tend to put folks in a foul mood, and we saw that in some consumer surveys. In short, people love low unemployment and hate high inflation, and now we've got a bit of the opposite, rising unemployment but cooling inflation, which is a weird new world. One more headline grabber: President Trump's economic policies continue to make waves in personal finances. His import tariffs have lifted the average U.S. tariff rate to the highest since 1934, contributing to higher prices on many consumer goods. Inflation, while down from its 2022 peak, has been somewhat sticky, partly due to these tariffs raising costs. Ironically, just as businesses were starting to adapt to the tariffs, a court ruling declared many of them illegal, injecting fresh uncertainty. Businesses remain in a state of flux, unsure if they'll owe back tariff payments or if supply chains will need reconfiguring yet again. If you've noticed the price of your favorite gadget or appliance bouncing around, that's the tariff whiplash at work. Meanwhile, Trump's unusual decision to fire the head of the Bureau of Labor Statistics, BLS, after some data revisions he didn't like is another wild card. Apparently, blaming the messenger isn't just for bad news at work. The BLS produces all those key reports, like inflation and jobs numbers, that guide the Fed. Replacing its commissioner with a loyalist, who once mused about suspending the jobs report entirely, has economists across the spectrum raising eyebrows. The worry is that political interference could cast doubt on the data's credibility, a terrifying thought for investors and policymakers who rely on honest numbers. We'll keep an eye on that saga. For now, data still seems solid, but any sign of fudging would be like setting off a fire alarm in financial markets. Bottom line for the US, the first week of September delivered a reality check. The economy is slowing, maybe too much, and the Fed appears poised to shift from fighting inflation to propping up growth. For personal finances, it's a bittersweet turning point. On one hand, relief may be on the way for borrowers. If the Fed cuts rates, interest on mortgages, car loans, and credit cards could finally stop climbing or even inch down. Credit card APRs might retreat from record highs. Prospective homebuyers and refinancers, this could be your moment. Start those mortgage applications if rates dip. On the other hand, an economic slowdown means job security could become a concern. We're already seeing companies pull back on hiring, and some have quietly initiated hiring freezes or even layoffs in anticipation of tougher times. As one economist quipped, the economy is skating as close to the edge of recession as you can get. It's a delicate balance. Inflation is moderating, which is good for your grocery and gas bills, but if that progress comes at the cost of a recession, nobody's going to be throwing a party. Stay tuned as we watch if the Fed can pull off a smooth landing, and maybe keep a parachute handy for your portfolio, just in case. Oh, and in case you were wondering, the stock market, September effect, is nothing mystical. It's often when investors refocus on fundamentals after summer. This year, fundamentals include slower growth, political drama, and still high prices. In other words, Mr. Market has plenty to chew on, and he's feeling a bit cranky. United Kingdom. Inflation bugs and amp. Housing hugs a row of houses in London. UK home prices have hit record highs even as the economy faces high inflation and interest rate shifts. Over in the UK, the economic storyline could be ripped straight from a soap opera script. Stubborn inflation, a central bank doing a surprise plot twist, and a housing market that seemingly lives in its own reality. Let's start with the Bank of England's latest move, which has people from Threadneedle Street to Tottenham talking. In a notable about-face from its long string of rate hikes, the BoE cut interest rates in August by a quarter point, bringing the benchmark rate down to 4.0%. Yes, you read that right, a rate cut. It's the first BoE rate reduction in years and puts rates at their lowest level since early 2024. For context, the BoE had been aggressively hiking borrowing costs to combat soaring prices, peaking the rate at 4.25%. Now, with inflation finally coming off the boil, they've started gently tapping the brakes on those costs. However, before we break out the champagne, Governor Andrew Bailey delivered a reality check worthy of a wet British autumn. He warned that there is considerably more doubt about how quickly or when they can do further rate cuts. In testimony to MPs on September 3, Bailey basically told everyone, "Hold your horses, we're not out of the woods on inflation yet." In fact, BoE staff expect inflation to rise slightly to around 4% later this year from its current 3.8%. That's still double the target, 2%, meaning the BoE is only cautiously inching toward easier policy. As Bailey put it, markets had gotten a bit ahead of themselves in expecting rapid-fire cuts. Now they've understood that the outlook for the pace of cuts is more murky. Translation: interest rates might stay at 4% for a while before the next cut, unless inflation behaves exceptionally well. So why is the BoE tapping the brakes at all? Two reasons: inflation and the job market. UK inflation, while way down from the 11% peak of 2022, is proving sticky around the high 3% range. July CPI was about 3.8% and could tick up to 4.0% by the autumn. A mini resurgence largely due to food prices and some tax changes. Notably, Brits are still seeing nasty food inflation. Grocery bills have been the bane of many households, in part because of higher costs and also a tax rise on alcoholic drinks and some employer costs that fed through to prices. The BoE is worried these price pressures might not fade as fast as hoped. On the other side, the labor market is showing signs of softening, which usually helps with inflation but carries its own risks. Unemployment has nudged up from historic lows, and wage growth, while still robust, could cool if the economy slows. Bailey expressed he's more concerned about signs of weakness in the labor market. Essentially, the BoE is tiptoeing a fine line. They need to support an economy that's losing steam, hence the rate cut, but must stay vigilant if inflation decides to be naughty again. As he vividly underscored, future cuts will happen only when it's safe. There is now considerably more doubt about when and how quickly we can make those further steps to lower rates. One dramatic subplot is the surge in UK bond yields, something Bailey was grilled about. In late August and early September, yields on long-term British government bonds, gilts, spiked sharply. The 30-year gilt yield hit its highest level in 27 years. Yes, you read that correctly. UK long-term borrowing costs haven't been this high since the late 1990s. Other bond maturities saw yields climb too. Why does this matter? Because higher gilt yields translate to higher costs for everything from government debt, a headache for the Treasury, to fixed-rate mortgages. It's a bit paradoxical. The BO cut short-term rates, but longer-term rates jumped due to global investors worrying about rising government debt and global rate trends. Bailey tried to downplay the 30-year yield significance, saying it's important not to over-focus on that one number since the UK isn't currently borrowing much at that duration. Still, the trend of rising yields is hard to ignore, especially for homeowners looking to remortgage. Many Brits coming off 2-year or 5-year fixed mortgages are discovering the best available new rates are much higher than their old deals, even with the BO's recent cut. And rising gilt yields in late summer meant some lenders actually pulled mortgage deals or repriced them upward, fearing their funding costs would rise. It's an unwelcome déjà vu of late 2022's bond turmoil, when that infamous mini-budget sent yields soaring. The silver lining: if global markets calm and with the BO not hiking anymore, mortgage rates may stabilize. In fact, the average 5-year fixed mortgage eased slightly under 6% after the BO cut, still high, but a tad better than the peak approximately 6.5% seen earlier. Now, let's talk about something Britons follow almost as passionately as football: house prices. Despite all the cost of living pressures, the UK housing market is defying gravity again. August data from Halifax, one of the nation's biggest mortgage lenders, showed house prices rose 0.3% in August, marking the third consecutive monthly increase. That pushed the average UK house price to a record £299,331, about $404,000. Yes, record high. Cue the sighs from first-time buyers. Prices are up 2.2% from a year earlier, which actually is slower than general inflation, meaning in real terms, houses barely kept value. But the trend is what matters. After a soft patch, housing momentum is back. This beat economists' expectations. They predicted only a plus 0.1% uptick. As Halifax put it, 2025 has been a story of stability in housing. Since January, prices cumulatively rose by less than £600, showcasing how steady the market has been despite broader economic challenges. What's driving this mini resurgence in housing? A few factors: improving affordability, believe it or not, resilient demand, and some policy cliffs. Mortgage rates had actually fallen slightly from their peaks, especially with anticipation of BO cuts, which improved affordability for those looking to buy. Halifax notes that resilient demand and better affordability have supported prices, and they expect a slow but steady climb in home values through the rest of the year. There was also a rush of buyers earlier in 2025 to beat the end of a temporary tax break on property purchases, a stamp duty cut, which boosted prices in Q1. Even though that tax break has expired, it created a higher floor from which the market is now advancing more gradually. Additionally, mortgage approvals picked up to a 6-month high in July, indicating more people are locking in loans, perhaps encouraged by the prospect that rates have peaked. Lenders have also started competing a bit for business, offering slightly better deals, like longer fixed-rate terms or cashback incentives, to entice borrowers now that the frenzy of 2022-2023 has cooled. Regionally, the picture is nuanced. Not everywhere is hitting records. In fact, the southwest of England saw prices fall 0.8% over the past year, the first region to post an annual decline in a while. Why Southwest? Places like Cornwall had a pandemic-era boom in second home purchases, driving prices up, but a new 100% council tax premium on second homes introduced in April has dampened that market. Essentially, hiking taxes on holiday homes cooled demand there, which is exactly what local authorities intended to help residents. Meanwhile, Northern Ireland is leading the pack with prices up 8% year-on-year, though even that is down from over 9% the month before. Scotland and Wales saw 4.9% and 1.6% annual growth respectively. And the ever-expensive London? Pretty tame, up just 0.8% annually, with an average price £542,000. London's sluggish growth suggests the affordability ceiling has been hit. There are only so many oligarchs and overseas investors to keep dropping millions on London pads, and locals certainly can't afford much more. But despite weak growth, London still holds the title for priciest market in the UK, no surprise. For renters, there's little respite. The rental market remains red hot. Average rents for newly advertised tenancies hit a record £1,577 per month, up 3% from a year earlier. That's actually below general inflation, but when rents are this high, any further rise hurts. The demand-supply mismatch in rentals, partly because some landlords sold properties during high prices or because of less buy-to-let activity due to tax changes, means tenants are often competing fiercely, driving rents up. If you're a renter in a city like Manchester or London, you might be experiencing bidding wars for half-decent flats, something virtually unheard of a decade ago. On the policy front, there's an important date circled on calendars, November 26th. That's when Chancellor Rachel Reeves, notably, a change from previous Chancellor, indicating a Labour government in power as of 2025, will unveil the annual budget. Rumors are swirling that the budget may include changes to property taxes, especially on higher-priced homes. The mere hint of, say, a mansion tax or adjustments to council tax, has made some upscale market buyers a bit skittish. An industry body, RICS, noted that some buyers appear cautious, perhaps rushing or pausing decisions depending on what they suspect might happen in the budget. If taxes on £1 million plus homes go up, that could cool the top end of the market. Conversely, any new first-time buyer incentives or stamp duty tweaks could spur activity. It's a space to watch for anyone planning a real estate move in the coming months. So, where does this leave UK personal finances? Kind of in a perplexing spot. Interest rates, they've finally come down a notch, a relief for borrowers. If you have a tracker mortgage or variable loan, you might have seen a slight reduction in your rate. If you're on a fixed mortgage due for renewal, the bow cut means rates might not climb further and could even be a tad lower by year-end. Markets are 50-50 on another 0.25 cut by Christmas. But don't expect a return to the ultra-cheap 1% mortgages of yore. Those days are gone. Expect something in the 4 to 5% range to be the new normal, for a good deal, at least until inflation is truly conquered. Inflation and wages. Price rises have slowed, but 3.8 to 4% inflation is still outpacing many pay raises, meaning the cost of living squeeze isn't over. Energy bills are lower than a year ago, thanks to drops in gas prices, but food is notably pricier. That said, wages in the UK have been rising at the fastest pace in years, around 7 to 8% annual rate recently for total pay, which is helping households cope, albeit at the cost of potentially fueling more inflation. It's a bit of a tug of war. Workers try to catch up to last year's inflation, and the bow frets that those pay rises might embed high inflation expectations. At least petrol prices have been relatively stable this year, small mercies. Housing. Homeowners can breathe a small sigh of relief that the feared house price crash hasn't materialized. In fact, existing homeowners are getting wealthier on paper as that Halifax index climbs. But for aspiring homeowners, record prices are a kick in the teeth. High prices plus still high mortgage rates equals the worst affordability in decades. A typical first-time buyer household can only afford 17% of properties on the market, according to a new report by Ray Group and Combank. That's a record low availability going back to 1995. It currently takes nearly 6 years for an average income household to save a 20% deposit for a median home, and in some places like South England, closer to 7 years. It's brutal. The government's schemes, like Help to Buy, which ended, and the new 5% deposit home guarantee scheme launching next month aim to help first-time buyers get on the ladder. These let some buyers purchase with just 5% down and no costly mortgage insurance. Great, right? The catch: by boosting demand, such schemes may actually push prices higher for the limited supply of affordable homes. It's like a waterbed: push down in one area, it bulges somewhere else. Humor, side note. Many Brits joke that owning a home is a national obsession, and if you listen to pub conversations or morning TV, you'll hear endless property talk. With prices nearly £300,000 on average, it often comes with gallows humor. I paid £5 for a pint, but that's nothing. My house earned £20 a day just sitting there. Indeed, for some homeowners, recent monthly price gains mean their property is earning more per day than the average Briton's daily wage. Not exactly how economics should work, but hey, that's the quirky UK housing market for you. In summary, the UK is at an inflection point. Inflation is down from the scary heights, but proving sticky on the descent. The Bank of England has tentatively shifted into rate cut mode, yet remains on high alert. It's easing, but with one foot hovering over the brake pedal in case prices flare up again. For consumers, some relief is coming. Energy bills are lower, petrol isn't spiraling, and hopefully mortgage rates will at least stop rising. But the hangover from the inflation surge, higher prices in shops, higher rents, and diminished purchasing power, is still being felt. Keep an eye on wage growth versus inflation. That will determine if 2025 ends with households feeling better or still squeezed. And as always in Britain, keep an eye on the weather. I mean, the housing market, but also the weather. If you're a first-time buyer, maybe lobby your MP for more housing supply, or failing that, a new Help to Buy ISA. In the meantime, perhaps practice making tea. You'll need the comfort as you peruse Rightmove listings in disbelief. Chin up, though. At least the UK's inflation isn't as wild as it was, and there's the hope that by next year, 4% will refer only to mortgage rates, not price increases. Fingers crossed. Do not forget to subscribe and visit personalfinancetime.com.